Hi, everyone. Welcome to Arts Business Collaborative's Help Desk. Today is finance skills you need to know as an executive director. My name is Joshua Boschman. I'm the CFO for Arts Business Collaborative. I have been working in the nonprofit sector, uh, honestly, kind of all my life. I started as a summer job. Um, in school and sort of stuck with nonprofits through my career. Did I say in summer school? During high school in the summer. And so yeah, I would say let's get started. Do you want to start the next slide, Carolyn? Oh, yes. For accessibility purposes, we do have subtitles. Zoom offers subtitles that you can turn on, and it will put subtitles on anything I'm saying. I will try to pause between points, give people a chance just to put down whatever notes they want. Uh, uh, we'll be going over terms, and we'll be covering uh, the agenda. Um, Oh, I'm sorry. We do not have an agenda, but that's okay. Um, um, we do have resource sharings, so we do share resources and knowledge in the chat. These slides will be available to all of you. However, the way I tend to use my slides is just to cover the topics, and then I do a lot of speaking. So you may still need some notes in addition to the to just having the slides. This is being recorded. Um, we are planning on also releasing a fundraising handbook in May, which will cover a lot of the topics that we're covering for this presentation, as well as the other three presentations that are happening through our help desk. Two of them have already happened. One of them is upcoming, and I'll talk about that one. I'll remind you guys about that and give you more details at the end. Um, Okay, so Arts Business Collaborative, what we are is we are a 501(c)(3). We provide technical assistance, we try to do some research, and we provide capital provisions to improve the quality of life of people of color involved in STEAM. Uh, our we essentially try to provide access to capital, access to networks, and access to knowledge. So this kind of is part of our access to knowledge aspect. Um, uh, like I said, we already talked about help desks, free 6 week long project program we offer typically twice a year. We are up to this. We have this course and then another presentation, and I believe that wraps up our help desk.
Oops. Sorry. We will have a
That's all right.
wrap-up session as well. Yes.
And and then the other thing we have is our grassroots action project, which is where we try to help uh, businesses and movement organizations and in and provide them the different access to capital, knowledge, and networks that they might need in order to be able to succeed and eventually be able to spin off as their own independent entity, as their own 501(c), or as long-term semi-independent entities under a Model L fiscal sponsorship. Um, yeah, I already talked about myself. All right. Yeah, okay. So I figured just because there's a wide range here that tends to come to help desk, I just wanted to start with just talking about what type of entity you're currently in and maybe what type of entity you want to become, right? Um, so there's for the purpose of this, there's really just four types of entities. There's ways to split these up a little bit more where it becomes like dual partner LLCs um, and and C corp and S corp. Um, but for the purposes of today's presentation, it really comes down to are you a 501c, are you an LLC, are you a sole proprietorship, or are you a sponsored project? So the first one is a 501c. That tends to be a lot of people's uh, goals if they are providing charitable uh, work because it does come with a lot of benefits. Um, but it does require that you have a bylaw set up ahead of time. It does require that you have um, if you're offering a retirement plan like a 401k, it requires a TPA, which is a third party actuary, which is a person from a different company that specializes on this type of work, and their entire point is just to uh, basically make sure that you're not using charitable funds and mismanaging them within people's retirement plans. The government cares that 501(c)s do this. Private organizations do not have to do this. Private organizations can mismanage people's 401(k) plan as much as they want, I guess, and then they would just deal with the individual lawsuits from retirees. For a nonprofit, there's actually a third person who's watching over, making sure that you're meeting the requirements of your 401(k) plan. Um, if your 401(k) plan has over 100 participants, you'll also be required to have an additional audit just for the 401(k) plan. Um, uh, After 750 grand from federal funds, and you're also required to have a mandatory audit. Um, if you're receiving charitable funds, you will need that audit in order to fill out your charitable organization application with your state. Um, this is definitely goes state by state. There are the 750 grand mandatory audit is a federal requirement, but there some states require audits at different amounts um, if you're making and this is for your overall income. This isn't just for your federal funds or just for your state funds. If you're making over a certain amount, you then have to have an audit. Um, uh, uh, Definitely check within your state because, like I said, different states have different thresholds. Uh, New York, for example, New York State requires a financial review, which is easier than audit at over 250 grand. Um, and I will answer that in 1 second. And then once you hit 750 grand, then you have to have an audit because you hit the federal requirement, and I believe New York State's requirement actually matches the federal one. Um, just take note that if your fiscal year ends after September 30th, 2025, it is going to become $1 million. So that threshold just became a little bit easier for people. Um, if you are fiscally sponsored, and we'll talk about that a little bit more when we get to fiscally sponsored people, but you do not have to have your own individual audit. However, you are under your fiscal sponsor's audit, so they will have to you will have to have all the correct paperwork so that you don't put your fiscal sponsor at risk. If you uh, and that can lead to you being removed, right? Your fiscal sponsor ending your contract as a sponsor project, and then everybody's out of a nonprofit status. So definitely, even though it's not your audit and you don't have to deal with the stress of the audit, you still need to uh, be meeting the requirements that your fiscal sponsor is asking for, because typically those requirements are for audit purposes. And what you gain from a 501(c) though is you gain a nonprofit status, which is a pretty big deal. It allows you to it makes it much easier for you to receive grants. And foundational and corporate funding is comes much easier if they're able to put it as a tax write-off. Same as individual funding. Some individual funders will follow a little bit more their heart, but but the I find at least that bigger the bigger donations come to those who can then also provide um, uh, a tax deduction for the person donating. Um, okay, next slide. Okay, the next one is an LLC. LLC is a limited liability corporation uh, company. Sorry. Um, it its sole purpose is just to help limit liability. It really doesn't do much else for you. Um, it allows you to have a separate bank account, um, and it allows you uh, to have a separate name that you get to sort of put out there for your organization. Um, if you don't have an LLC and you're just working off an organization, it might behoove you then to get a DBA, which is a doing business as, um, to be able to use the name that you chose to in more official ways. But otherwise, Um, when you file your taxes for LLC, the LLC still goes under your taxes. It's all one tax form, unless you filed as an S corp, uh, uh, which then kind of separates it out a little bit, um, and that can help you a little bit tax wise. I tend to suggest for people to not file as an S corp until they're sure that their LLC is making about 40 to 60 grand a year. Otherwise, you kind of spend more on filing fees uh, than you are saving taxes. The key to an LLC though is that you need to maintain a corporate veil. So once you have an LLC, you definitely want to get yourself a bank account under your LLC's name. You want to make sure that all funds coming into your LLC stay within your LLC. You want to make sure that you're doing quarterly meetings, even if it's with yourself, and that get written down. So you want to write down like uh, 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 corporate minutes, right? Where you are sitting with yourself and making the decision that you need a laptop, right? Um, or you are uh, talking about reporting on how taxes were done, right? Even if it's with yourself, having these type of forms is what helps maintain a corporate veil. And a corporate veil essentially is what keeps the corporation of the LLC separate from you, even though you're filing the taxes together. Um, Otherwise, what can happen is if you individually get sued, let's say you're in a car accident and you end up in a lawsuit, uh, they can technically then go after if you break the corporate veil, then they can sue for both your personal funds and the funds in your LLC. Um, and the other way around as well. If you have an LLC and that LLC gets sued for some reason, and you've broken that corporate veil, then they can start looking at, they will use that to show that there isn't a corporate veil. They'll show that like you're using your personal checking account, or that you're using your personal credit card to pay for things, as a way to show that you don't have a corporate veil, and therefore can be held accountable. Your personal funds, your home and your car can then be part of the total funds that the judge is using to decide what type of compensation would come out of a lawsuit. But if you're keeping your bank account separate, you're keeping uh, you're keeping those minutes, so it's not you buying yourself a laptop with the money from the LLC, but it's the LLC uh, getting you a laptop with the LLC's money, uh, then that keep maintains that corporate veil. And then uh, if something were to happen in either direction, they wouldn't be able to then start counting the funds from the LLC or the funds from you. Um, they would just keep each other separate. Okay, next slide. Oh, actually, just real quick, if you are doing an S corp, that does mean that you then have to start giving yourself a salary, and your salary needs to be something equivalent to the type of work you're doing. So if you're like a social worker and you're doing social worker type work, then you would start off by giving yourself a social worker income. Um, that would be typical for a social worker as an S corp, as opposed to paying yourself as like the owner of the LLC. Um, so just keep that in mind if you are someone who's like, oh, I do make 40 grand, 60 grand a year. Let me just go to an LLC and do it as an S corp. There's a little bit more that you have to do. Um, and you're then filing separate taxes. And in those separate taxes, you're getting a W-2 from your LLC. Um, Okay. Next one is sole proprietorship. Honestly, sole proprietorship is the mass majority of the United States. That is just a person who's decided to start working, whether it's a bake sale, an art school, being an art teacher. If you're doing your own business or organization, and you don't have one of the other ones, you're a sole proprietorship. And essentially what that means is that there's literally uh, no difference between you and the organization. You are your organization at that point. Um, and I guess the plus sides is that you don't have to do any of that paperwork that I just talked about with the LLC. However, you do end up then having all the liability, and your taxes just get filed as part of your personal income tax. It's not even like an additional schedule in your personal taxes the way an LLC would be. Um, okay, next one. All right, and then there's sponsored project. And except for a Model L, which a Model L is essentially what an LLC would have as a sponsored project. The way it works is that your taxes are filed by your fiscal sponsor, like we mentioned before. Your fiscal sponsor is taking on most of the risk. That's part of why you're paying a fee to your fiscal sponsor, is because um, your the most risk that you're taking at that point is the health of your organization. But as far as uh, legal issues, issues with your 501c status, um, uh, or yeah, I guess mainly those. It would those would fall on your fiscal sponsor, which is why it's important to work with your fiscal sponsors as a partnership and where you're both working together to maintain healthy nonprofit status for both of you, right? Um, there is a lot less paperwork because you're not filing taxes, you're not doing quarterly uh, uh, your quarterly tax income reports to the IRS. Uh, for your employees, you don't have your own W-2s. Um, However, it is a slower progress because you are working with an additional person, so you can't just say you're going to do something and then immediately do it. would want to then bring your idea to your sponsor project, and then your to your sponsor project to your fiscal sponsor, and then you would have your fiscal sponsor approve it, and and then you would move forward, right? Depending on the type of sponsored project that you are, the type of model, typically your fiscal sponsor would be the one that's uh, paying the bills for you and receiving the money for you. So you don't have a bank account. The fiscal sponsor has the bank account, and then they're paying your invoices, and your staff, including yourself as the executive director, would become W-2s of that fiscal sponsor. Um, let's see, less autonomy. We talked about that. Get all the yeah, but in return, you get all the benefits of a nonprofit without having to go through the lengthy process of getting a nonprofit. You don't need to set yourself up with bylaws. You don't need to create yourself a board, and find people to be part of your board. And you don't have to have any of the reporting. Um uh, uh, Trying to think if there's anything else. I think that's it for sponsor projects. Okay. The next thing is just to go over again, just a couple more definitions. It's just different type of finance positions that are out there. Sometimes people get confused exactly on what the different positions do, and therefore um, might have unrealistic expectations for the position at hand, right? And then are surprised when they get pushed back. So the ones we're going to talk about mainly is a bookkeeper, billing specialist, finance manager or finance director, and a chief financial officer or CFO. Um, okay, so bookkeeper. Bookkeeper tends to be the backbone of your finance. They're the ones that are really going into QuickBooks or Excel, whatever you're using, and making sure that everything's getting logged and it's getting tracked the way you want it to be tracked. It can be difficult to find a good bookkeeper, if for no the reason that it just requires a high level of accuracy, and not everybody can have a high level of accuracy when they're data entering. Um, However, a bookkeeper is just that. They're just a bookkeeper. They might, if you get a nice one, they might be willing to track your insurance for you, uh, or if they work for you, they'll probably be also doing your payroll. But the actual decisions and the quality assurance would come by the supervisor. And if you're a small organization, um, typically that means that the executive director is the supervisor, right? And so if you're an executive director and you hire a bookkeeper, just expect that you're still going to be expected to like review payroll. They might set up payroll for you, um, but you're expected to then like review it and approve it before it actually goes out. Um, and Same with you should be reviewing the bookkeeper's work at least like once a month when they close out their work, pull out a report and make sure that all the transactions are being allocated the way you want them to. Um, Bookkeeper's typically not going to make a top level decision for you. If they're especially I find the more experienced they are, the less likely they are to do that because um, uh, the thing with being a bookkeeper is that they're not, if there are errors with payroll or there's errors with your reporting to a government organization, um, that falls on you as the executive director. It doesn't fall on the bookkeeper. The bookkeeper's simply there to enter things as accurately as possible. But the decisions of how it gets entered, where you want it, um, it really uh, becomes uh, your decision as the executive director. Okay, next slide. Okay, a billing specialist. Billing specialist really comes in like you grew a little bit more, and now you just are in an organization where you're receiving a lot of small earned income from a lot of different people. Education, um, whether it's like a ballet school or or an after school program, or even like a straight education preschool daycare type of thing. Um, Once you get to a certain size, you're probably going to want a billing specialist, because you're having to uh, uh, bill each individual person and keep track of who's paid, who hasn't, how much they owe, who needs to get rebilled because they sent like a partial payment, but you still need the other, 10% of the payment. Um, and then the other time is if it's just highly technical billing fields. That tends to be more on the lines of like if you're somehow associated with have to deal with medical billing within your organization, that would be an example of like a highly technical billing field, where the bills have to be in a specific way, with specific formats, with specific coding. Uh, then you kind of want someone who's going to specialize on that. Now, of course, if you're small, as an executive director, that might be uh, that's probably going to be you at first, right? However, as you grow in size, there's going to be a point where you start thinking that you need someone, and when you're trying to figure out what you need, then a billing specialist would be one of those options, and it would be and if you were to hire one, that would be what would be expected of them is simply to like deal with sending out bills and keeping track of what's been billed and what still needs to be billed. They still require a quality assurance by supervisor. So even if you have a billing specialist, um, they're still not uh, management. There's still needs someone to make top level decisions. Like, are we still going to continue to chase this bill? Or are we going to call it a loss? It still requires quality assurance. It still requires someone to sign off on those bills and on the reports that they've sent. Okay, next one, Carolyn. Oh, there we go.
It was hanging
Uh,
up, sorry.
No, it's all right. We got a little typo. That's okay. Finance manager or finance director. Uh, so if there's a CFO, then they're basically middle management in large companies. So they're um, typically doing very similar jobs to what the CFO does, but for a sector of your organization. Most companies aren't gonna have both a finance director and a CFO uh, until they get to a certain size, just because um, you really need them once you start getting to each department is so big that it uh, when it comes to time management, someone needs to be able to like watch them and keep track of them. Um, um, I would say that if you're not receiving audits yet or consolidated fiscal reports, which is something that you're required to do if you're taking government money from a certain from certain agencies, they will don't worry though, they will let you know if you need to do a CFR for their agency. Um, then your finance manager or finance director can be the top finance position at your organization, and they're just reporting directly to you as the executive director. Um, However, I would suggest that like if you do have audits or you do have CFRs, but you're not big enough to have middle management, which is frankly the vast majority of us, um, uh, I would suggest making whoever you have your finance manager or finance director be your CFO if you're a 501c. If you're a fiscal sponsor, I'm sorry, if you're a sponsored project, um, or you're an LLC, the name will matter a little bit less um, for the jobs. But once you start getting into nonprofits and requiring a board, then you need someone whose job is to speak to the board. And the difference between a finance director and a CFO, a lot of it really just comes down to like liability and personal risk, right? Like a CFO, like a CEO, can be held liable in lawsuits. And meanwhile, a finance director, if you're under a board, uh, won't, because they're not considered a top level position within the organization. They're not an officer in that organization. But if you're an LLC, or a sponsored project, um, uh, uh, then the names can become a little bit more interchangeable for like your top finance position, right? Um, but when you're getting an audit, especially if it's an audit that's not an independent audit, but from like the Department of Labor, um, or or the controller's office, uh, they they're gonna want to speak to the person uh, who's responsible, and the person who's responsible uh, in a nonprofit organization is the CFO, not as much the finance director. If you don't have a CFO and you get audited, then like you're gonna need your you as the executive director are probably going to need to be a part of the audit, even if it's just you sitting in the room while the finance director is explaining the finances, because you're the one that's responsible. Um, so finance managers and directors should be able to produce financial reports. They should be able to create budgets. Uh, they should be able to understand some, if not all, of the financial regulations that affect your sector. Um, if they don't know them coming in, that's definitely something that you would want someone immediately to start training for, to understand the regulations of your sector, because they are um, even if it's a large company, they're going to be the ones responsible for maintaining those regulations within their department. If it's a smaller company, then they're going to be the ones responsible for maintaining those regulations for the entire organization. Um, I do want to just say real quick that the bookkeeper can produce um, some financial reports for you if they're running it. Uh, uh, they just won't really be able to. Uh, they're really just going to be handing them to you for you to then go present, and so they can help explain them to you. But it's typically not within the bookkeeper's job to then go and present on those. And same with the billing specialists. Billing specialists will have their own reports that they can pull out, that you can ask for, and they can prep you. But once it comes down to presenting to a board, that really falls outside of the realm of like the bookkeeper and the billing specialist. Okay, next slide. Okay, and then you have your CFOs, your chief financial officers. So like I said, CFO really performs generally the same duties as finance director. They just view the company as a whole with a broader view. And this is for like definitely for smaller to medium-sized organizations. Um, the other difference is that if you are have a 501c, and that means you have a board, and because CFO is an officer, that means that they have to be hired by the board of directors. So you as the executive director can't just go and hire yourself a CFO. Meanwhile, you as the executive director uh, can go and get yourself a finance director. Um, um, and again, that's because the CFO really bears the liability for any financial issues in the company and can be named in lawsuits the same way any officer or board member can. Um, the other thing with CFOs is really comes once you get to like um, much bigger organizations, because the CFO is also then responsible for uh, uh, creating financial valuations of of your company to be able to tell you how much your company should be worth. Um, and for the purposes of selling your company to another company, or vice versa. They should be able to, they're then responsible for also reviewing other companies for the purposes of purchasing those companies, as well as making decisions on different stock options and investments that a company might have. That also falls onto your CFO. But the vast majority of us don't have companies of that size, nor do we have uh, C corps, which are publicly traded. Okay, next slide. Yes, honorable mention for controller and a comptroller, which are typically pretty similar names. So if you are in a private sector and you are in a very large company, you may also have a controller, and a controller's sole purpose is to evaluate and create, um, evaluate the accuracy of all the reports that are being created. Um, so at that point, your finance director is managing and making decisions on the finance for the departments. The CFO is managing and making decisions of the finance of the company as a whole, and the controller is sole purpose is to generate the reports when they're needed and ensure that those reports uh, are showing accurate numbers. Um, and when you get to be, you know, that big, it does become necessary to have someone like that, because there's just so much uh, cash flow moving around that you need someone just to make sure things are accurate as like their sole job. Um, Now, a comptroller with a P is basically a CFO or finance director, but for the government. So that's why you will have like elections for the comptroller, for the city comptroller in New York City, and different things. Is because that's the person that's managing the finances for the city or the town or whatever point your government. Um, it is. I know it confused me a lot when I was starting, so I just want to throw those out as honorable mentions, even though they're uh, uh, not something that you will probably have to have for yourself, but it is something that you will. Definitely come across as you deal with government more and more. And when you get applications and they ask for like your comptroller's name, they're really just asking for like your finance director or your CFO's name. Okay, next slide. What software should you be using? Okay, so this depends. Can we go to the next slide? Yeah. So you got a couple of different things out there. So you have Excel, which is tried and true. You do have other um, data software, which is really what I should have called it. Um, but Excel is just the one that's used most often in the accounting world. Um, So if you use, I find like I use Google Sheets and Excel together. Um, Google Sheets within the company, but then when I go to deal with my auditors or my accountants, I uh, transfer my Google Sheets into Excel, so that I don't trip them up too much by changing things on them. Um, as far as like keeping your accounts on Excel though, if you are a small organization with small amounts of transactions happening throughout the year, um, you can use Excel. If you can afford it, I would move towards an accounting software pretty quickly. But Excel, no one's going to fault you for using Excel as long as you're keeping accurate numbers with it. It just becomes exceedingly difficult to keep accurate numbers in Excel, um, the more transactions that you have, because each transaction becomes a line, and then and it's you can't do the financial reports that you would typically expect. If you're a 501c, you 100% need to be using accounting software. Um, uh, because there's specific financial reports that you need to be putting out, um, even if it's just for your board or your treasurer. Okay, accounting software. Typically the one that gets used the most. There are other ones. I'll be honest, QuickBooks has such a monopoly on the system that I often struggle to think of other ones, even though I know other ones exist. Um, uh, I've yet to meet an accounting firm that uses a different software on a regular. They might touch it if that's what the client's using, but then um, now you got to deal with like an accounting firm that's learning your accounting software, and that's an extra hurdle. Um, so I typically would say use QuickBooks if you're going to get yourself an accounting software. You still have to enter things like you would with Excel. However, you can link it to your bank account so those transactions are coming in automatically into your QuickBooks. Just because the transactions are coming in to your QuickBooks doesn't mean that there's nothing for you to do. You still need to allocate them to different classes and GL codes within your organization. Um, so it doesn't get you out of the data entry that Excel has, but it does get you out of a lot of the confusion from having a lot of data entry that Excel can have, at least when it comes to finance. Um, uh, or uh, or specifically like uh, bookkeeping aspect of finance. Um, okay, the other thing you can have is billing software. I can tell you. Thank you. QuickBooks will give you a payroll software. It will also give you the ability to send out invoices and receive payments um, through it. I find personally that it is helpful to have separate payroll software than QuickBooks. I don't like QuickBooks. I find QuickBooks payroll to not be that great. At least the last time I've used it. Um, and there's just frankly better billing software out there than QuickBooks as well. So I could tell you for Arts Business Collaborative, we have uh, uh, QuickBooks for our accounting and bookkeeping. We use Bill.com for our for dealing with receiving invoices and keeping track of invoices. Um, and and then we have a different software for payroll, right? Uh, Currently, we use Rippling. Rippling's not awful, but there's plenty of other ones. There's Paychex, Paylocity, just to name two more. Um, all of these will connect to QuickBooks. They all integrate with QuickBooks, so they're pretty easy to use. Um, um, I would pretty much, unless you're like one employee, even with one employee, I kind of struggle. In my opinion, you should always have some kind of payroll software. And the reason for that is because payroll software will handle the taxes for you. And payroll taxes can be difficult if you do not have payroll software handling those payments on your behalf. Um, uh, Billing software is great because you can put your invoices right into the billing software. So then later on, when you have to account for a transaction, you can go into the billing software, look at that transaction, and have the invoice directly attached to it. QuickBooks Online does allow you to do this as well. However, QuickBooks Online will slowly become oh, that's awkward wording, but slowly become more slower, less responsive, the more attachments you put to it, right? However, QuickBooks does allow you to attach invoices to bills to bill payments. It does allow you to attach like grant contracts to pledges, but again, the more that gets attached, the slower it gets, which is uh, uh, which is where like a billing software can kind of handle that a little bit better. Um, and then the last one is the CRM, a customer relationship management software. So that's like Blackbaud or Salesforce. And their main purpose is for customer relationship. However, it is sorry, my computer is trying to make me not do this. I just had to tell it to not update yet. Um, so where CRM really comes in is if you're receiving several grants, it's really well works really well for keeping track of your grant money. It can be integrated into QuickBooks. And so then when you're allocating things in QuickBooks to specific grants, the CRM can then manage that and keep track of that for you much easier. So at least on the finance side, where CRM really comes in is for keeping track of grants and um, uh, and those grant contracts and making sure that you're maintaining to your grant contract if there's any kind of restriction on there. Um, and if not, then it's also maintaining that backup for when you have to do an audit. Um, it also is very helpful in a lot of different ways. It can be really helpful for fundraising. I personally don't participate a lot in the development side and the fundraising side, day-to-day side of things, but the CRM can help manage when was the last time I called this person? Do I need to call this person again? Is there a follow-up necessary? What did we talk about last time, right? And it can help keep track of all that kind of stuff on the same place. The downside to CRMs is that they are very expensive. They are very expensive and they typically need um, an IT person to manage it and change it and set it up for you, which then adds to that price. So I would suggest that the time for a CRM is either when you're receiving so many grants you can't keep track anymore, or you are able to uh, find it worthwhile expenditure to make a CRM that is both for your finance, for your fundraising, uh, right, and for your any kind of customer relationship management, because now you're getting uh, more bang for your buck. Okay, next slide. All right. So before we go to the next part, which is going to be reports, I figured we needed to talk about what the anatomy of a transaction is. So for the anatomy of a transaction, you need a couple things. You need to have the date of the transaction, whereas the type of transaction. So is it an income, is it an expense, or is it a journal entry? And a journal entry is something that you're creating to help organize those expenses. So typically it might be because it's like a split or because it didn't, the funds didn't necessarily come in through your account, um, or out of your account. Um, I got it. Um, the You also have to have a GL code. I'll talk about GL codes in a second. And you need a name. The name is like the the company, the organization, the person who this money came from or is going to. Um, a class, and we'll talk about classes in a second as well. Uh, a memo or description. I know this seems like a lot of people want to like to skip this. Um, uh, your memos and your descriptions is what can really make a difference when you're doing audits, um, and reviews, because a lot of it is going to be asking you about specific transactions, uh,
Ah,
a year and a half, 2 years later, and
God.
I'm sorry. Y- can we just make sure that yep, our mics are off? Thank you. Um, and so being able to write specifically what it was for will really just help you down the line. Um, account, like what account it came out of, um, or what split, and we'll talk about splits in a second. Um, the amount that came in, and then the balance, and then it tends to be like a running balance. So like in this example, the first transaction was $40. The second transaction was $30. So my balance went from $40 to $70, right? Um, Journal entries would also be where you do splits. So if we were to need to have like the Adobe subscription, for example, in this example for $40, let's say it was being split across two different departments in your organization, then you might want to split that expense so that you can allocate $20 to this department and of the expense and $20 to this other department for the expense. Um, and that's where your classes come in. So a class is a way that you split up your funding. Typically, your class is gonna be related to your organizational structure. So it would be keeping track and separating money out uh, from one type. Like let's say you do two types of programming. You would use a class to be like, this is for this type of programming, this is for this type of programming. Or if you have like restricted funds, uh, then one way to keep track of restricted funds, which is where you receive a grant and they tell you this can only be used for food, right? And it can't be used for pens or office supplies or anything else, just food that you're going to be handing out, right? Because that's your charitable work, and they don't want it used towards your payroll. They just want it to for purely for food. Then that would be a restricted amount, and you would need to keep track of that. And so you could set up a class for this food grant and then be able to then say uh, mark the different food expenses under that grant, so that way you can make sure that you're spending that money only for the intended purposes. Um, GL codes. GL codes are a little bit different. They're also a different way to separate money out. However, GL codes are across the board, so any class can have the same GL codes. A GL code is literally just stands for General Ledger Code. And that's what this would be. Like your general ledger is like the base um, spreadsheet where your money is being kept track of, whether that's by Excel or QuickBooks. The main one that has everything in it is your general ledger. And so general ledger codes, uh, there is no like standardized way to code things. I believe if you use QuickBooks, they'll just have some commonly used GL codes. Um, my suggestion is do not fall into the trap. Sometimes people feel like just because there's a GL code out there that they should use that GL code to separate their money out. Um, Separate out only what you need separated out. So if you're in a position in your organization where your organization isn't big enough to care about how much money you're spending on electricity versus how much money you're spending on like office supplies, um, then just keep it simple and just have like an operating expense GL code, right? And then as you grow and you start needing to separate those out a bit more, you can create a new GL code, and anything moving forward will then get separated out more for better reporting and for your better knowledge. There are certain things that you're definitely going to want separated in GL code. Typically, you want to have know uh, your administrative expenses separated out from the rest of your staff. So you are going to want like a GL code for officers. You're also going to want a GL code for fundraising. Um, you're going to want a GL code uh, for lobbying, just because these are the type of things that the government will specifically always ask you to separate. Um, but when it gets down to like the nitty gritty, sometimes people feel like they need to separate out just because you can, and having more GL codes does not create for better accounting. It can just add to confusion if you're not actually interested in those things being separate, if it's not actually helping you. So just keep that in mind as you go through GL codes. Um, okay, next slide.
Can I add something on GL codes?
Sure.
This is Kat. I'm the CEO of Arts Business Collaborative. I also want to just note that when you're putting your GL codes in for fundraising, it can be really helpful to make sure that you have your individuals separated from your corporations and foundations and government, and then also have that separated via restricted versus unrestricted for each of those items. Um, this is there are sort of ways that we might classify those funding sources that are not obvious. So if you have money that comes from maybe a family foundation, and that family foundation is literally like parents and a child, and it's really just an individual, but their giving vehicle is a family foundation, we might classify that as an individual gift, so that you can sort of understand more about the mechanics of that revenue source when you're making projections for fundraising or for finance reasons. You might also consider that a lot of corporations have corporate foundations, and those corporate foundations are um, ostensibly set up for the furtherance of their 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 parent or their main corporation's interests, but it does say foundation in the name. So um, for example, the MetLife Foundation, that is the MetLife insurance company, and they have interests that are similar to both the for-profit and nonprofit. So you would maybe articulate that as the GL code of corporate rather than foundation, because um, any kind of changes in the financial landscape of the country would affect it more like a corporation versus a foundation.
Exactly. And so creating your GL codes is a mixture of frankly the head of different departments, right? So it doesn't just fall on finance to create all the GL codes. It sometimes a GL code will come from your executive director, or a GL code will come from fundraising. And sometimes that's all one person. But it is a joint effort from all the different aspects of your organization. For example, uh, if you're doing a ballet school, uh, you as the executive director may not care whether you're the different age groups uh, that are coming in, how much money you're bringing in as an age group. You might not be big enough for that yet, because you know, putting them all into one class, right? And instead, you might just care about uh, 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 you just have a class, a beginner's class, right? And an intermediate class, and so and you're putting everybody together. But if you're starting to look for fundraising, then suddenly the age groups might make a difference to to your funding, and so then you're gonna want to then now keep track of how much money is coming in per age group, and you could definitely math it out after the fact, based on like the number of attendance and and keeping track, uh, but if you're doing it in real time, there's less error in the long run. Okay. Important reports. No, the the main three important reports that you want are your uh, profit and loss, your balance sheet, and your statement of cash flows, or cash flow statement. So all of these reports have multiple names, and you will probably come across them in multiple ways. Uh, Grant makers like to sometimes ask for these in different names, especially if you're working with like corporate grants, uh, because um, they come from the private sector, and so they're used to calling it one thing, but you've never called it that, and QuickBooks doesn't even have it for you because you're using like QuickBooks for nonprofit. I got it. Um, the So a profit and loss statement, or P&L, can also be called an income statement, a statement of earnings, or an earnings statement, um, a statement of operations or operation statement, or a revenue statement. So in nonprofit, you will most often see revenue statements or earning statements. But I have noticed that like in more recent years, um, the terms are being used even more interchangeably because everybody's using similar software. Um, However, the idea behind it is that like if you're a non profit, then you're not making profit. Therefore, you wouldn't have a profit and loss. You're making earnings, and so you have an earnings statement, or an income statement, and uh, and if you're working uh, on an accrual basis, then you have a revenue statement because it's not necessarily the earnings you've made already, but it's the revenue that is being accrued. Um, in general, though, again, they're all very interchangeable. Uh, uh, even when it was separated out more, it was still pretty interchangeable. It was just like what was being used in your. You would see the other ones more in different when you had to cross over into different sectors than your sector that you would see a different name. Now you kind of really see them all mixed up all over the place. So you might get a request for an earnings statement from one person and a profit and loss statement from the another person, and it's the same exact thing. Um, Same with balance sheet. A balance sheet and a statement of financial position. Statement of financial position is what typically was more used in the nonprofit sector than a balance sheet. And Statement of cash flow or cash flow statement, which is great that they flip it like that because they'll also use the acronyms. So an SCF or a CSF are the same exact thing. Um, so is a funds flow statement, a statement of changes in financial position, a cash statement, or a financial flow statement. All these are the same report. A profit and loss statement is goes through a range of dates. So you have to give it like a start date and an end date, and it will report to you um, where how much money came in and how much money came out uh, uh, and what your net earnings are for that time period. Um, and net earnings, just in case that's not clear to anybody, gross is the total that's made. So like if you have gross income, for you personally, gross income is the money that you made as a total. It's what you get told you're making when you're getting hired. Your net income is after taxes and everything comes out, how much is actually getting in your pocket. And so the same thing works with for organizations. Your gross earnings or gross income is how much the total of money you came in, that got brought in, and your net earnings or net income is the same thing as your profit, which is how much money you made after spending money. So how much money is left over. Um, Statement of cash flows also works similarly. You have to put a start date and an end date, and you're basically talking about uh, actual cash. A lot of nonprofits work on an accrual basis, and what an accrual basis means is that the date that you're putting in for like a grant is based on the pledge date, not on the date that the funds actually came in. So when it gets allocated from the bank account to your general ledger, you would be putting in the date when that promise happened, right? Or when that money wasn't, or if that money is intended for a specific period of time at the beginning of that period of time. And same with expenses. If it's an accrual basis, then if I spent like a 3-year license on something, I could then accrue it and split it amongst 3 years, because that is my cost over 3 years. Um, but if but your cash flow is uh, the actual cash that is in your organization at that moment in time. and the actual expenses that came in and out. So if you're small enough that you're using a single bank account, you just have one checking account, no savings account, nothing else. Uh, your bank account is essentially showing you your cash flows because it's telling you how much money you have in the moment, how much money you spent, uh, uh, by the end of that month, right? Like your statement is telling you what your cash flows are for that month. However, the reason why you still would want to track it is because if you're tracking your expenses as you're spending them, then you can keep track of how much cash you have in the moment, and then you don't surprise yourself by the end of the next month. Um, uh, Meanwhile, a balance sheet only has one date, and it is the date, whatever date you chose. Typically, it's the date, unless you're looking for a specific like date. It might be the like end of year, mid-year, quarterly. Um, but it is giving you your assets and your liabilities in that specific day and time. Um, and so that's going to keep track of uh, that's gonna give you a pretty good idea of like the health of your organization in the moment. Uh, Profit and loss statements uh, tend to be used a little bit more on a comparative basis. Uh, so they also give you the health of your organization, but like compared to the previous month or compared to the previous year. Um, it, it nope. If they're looking for a statement of cash flows, or a balance sheet, they're not looking for well, one, balance sheet and cash flows are two different types of reports, but they're asking for reports. They're not asking for your bank statements. If they wanted a bank statement, they would actually just call it a bank statement. But a cash, um, I have done projects where my cash flow was legitimately coming over from a single bank account, but they're not going to want to see the bank statement. They're going to want to see a report. Um, the other thing is that typically when you're looking at like a cash flow statement, they're gonna, it's a range. So it'll typically be more than 1 month, which a statement doesn't cover. So that way you can see how money is getting spent over time. Um, um, okay. Uh, let's see. Next slide. One. Okay. So this is a P&L statement. It's a pretty big one. Um, and so this looks pretty intimidating right off the bat, but we're going to kind of make it simpler. So if we go to the next slide, uh, now we're talking about 1 year. So if we go back one slide for a second, you will see that we're just cutting all these off and we're just looking at 2019. And so when you're looking at just 2019, it becomes a lot simpler to look at. We're going to break it down a little bit more. And the next slide, and we're going to look at just the revenue section. So if we go back to the previous slide, we're looking at just this revenue part at the top, and that's what this is. And so your revenue is the money that came in, right? And so for this company, they made money off of licensing their product, right? So this might have been a sample for like Amazon or something like that. I'm sorry, I don't actually remember, but but I believe it was like digital licensing for like their product. Uh, then how much money they made for organizations that might pay for like courses or support. Uh, how much money they made for cloud services. and then they have a sub category, a subtotal for their subscription revenue, and then their professional services that they offer. Uh, so instead of support, when they just went and did it for them instead of supporting them, and and that's the total revenue that they made, right? And the numbers weren't real, but I believe the organization, was some kind of digital organization like Amazon, just if that helps. Um, so these are your GL codes, and this is where they come in because they come in your reporting. So in your GL codes, when they were marking their revenue, they were like, this revenue is for GL code, uh, whatever number. Typically, you start at 1,000, then your next one is 2,000, 3,000, 4,000, 5,000. And the idea is then you might have sub GL codes. So you might want to be like, okay, cool, that's licensing. But under licensing, I might want to know how much I made from this type of license versus this type of license. And so that would be a sub GL code that I can then put. So if licensing was 1,000 and licensing for, I don't know, math products could be 1,100, and licensing for reading products could be like 1,200, right? So they're both under the 1,000 category. Um, but now you're separating them out a little bit more, but your top GL code is licensing. And so for this example, they essentially had one, two, three, four different GL codes uh, that are being reported here. And within those GL codes, they might have had a few sub GL codes if they felt that they needed to separate that out. Um, okay, next slide. Okay. So the next part of that report was their expenses. And so they have operating expenses. And so operating expenses is what you need to run the company, for the company to just exist. Um, Even if it had no clients or was providing no services or was providing or was not making any sales, um, you would still need to have certain things to run, right? If you have an office, then you need to be paying your rent, right? Um, uh, and so for them, um, there's sales and marketing is something that would be running, whether they're making sales or not. They are still going to be trying to make sales, right? Um, they're going to be doing research and development regardless, and general and administrative. Uh, 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 you're going to have employees and doing payroll regardless of what you're doing, right? Even if it's just yourself, right? And okay, and the next slide. Okay, the other type that you have is other income. And other income ends up being income that is typically what goes in here is like investments. If you have a checking account and your checking account's making interest, then the interest that's coming in would be under other income, right? If you have money and you're somehow putting that money into an investment portfolio and it made some money just through investments, that would count as other income. So it's essentially money that you're getting uh, outside of the work that you do. And next slide. Okay, so if we come back to the full year, the other thing you're gonna see is for their purposes, and they chose to separate out their expenses by operating expenses and then the cost of revenue, right? Because so this is how much it costs if they were not making sales. Um, they would not have these expenses, right? And so this is how much it costs them to make a license versus how much they received for the license, right? How much they it cost them for support versus how much they got paid for the support, and so on, right? And so um, uh, so that would be the additional line that they have for a lot of organizations. Um, you'll find that your cost of revenue is s- still part of your operating expenses, right? So like, um, I'm just gonna keep going to ballet schools because they tend to be a pretty good example for for a lot of things. So like if you have a ballet school, you still need a ballet instructor, and you still need to be paying that ballet instructor, even if you haven't gotten a single ballet student yet, right? You might not need that second one, but you probably need to have that first one on staff, even if that first one is you, uh, even if you have zero customers, right? If you're like running a shop, you need to have a sales clerk there, even if no money was made for the day, right? And so even though um, and so in those type of cases, you might find that you don't even have a cost of revenue line. You just have it is all in your operating expenses because what you have needs to exist regardless of whether you're making money or not, so that you can potentially make money in the future. Um, okay. And then the last things they just had was they just separated out their taxes. Uh, so they so if you look at this, they basically made 50,044 from their subscription revenue, but their total revenue, once you added the professional services, is 53,851. Uh, they to be able to have that revenue, they spent $9,393 right there in their total cost of revenue. And that number is then subtracted from that 53,851, and that's how you got that gross profit, um, because which is 44458. And the reason why it's gross profit, even though they're removing the cost of revenue, is because um, there's still a lot more expenses to go, right? Because there's still like your operating expenses aren't being accounted yet. Um, um, and then so then you have your operating expenses. Total operating expenses was right there is 92,335, which puts them at negative 47,877. If someone's not used to reading these type of reports, if you have numbers in parentheses, that's a negative number. So this is negative 47,877. So that means that or it will be marked red. That's another way to say it, or they're in the red, which is also a negative number, and the black is a positive number. Um, and so they lost uh, in 2019. At this point, they already lost $47,877. Um, but they did make 694 bucks from interest rates and things of the sort. Um, and so then their total loss uh, only becomes 47,183 uh, because you added that 694 to the 47,877 from that's the loss from operations. And and then from there they have a provision for income taxes. They expect that they're gonna have to spend $168 on income taxes, which then leaves them at a final net loss of 47,351 for 2019. So that's how you would read this. And if you go to the next slide, so now that you're able to read the one line, you can read all the other lines. And the only reason why they're next to each other is so that you can then compare them. So you can be like, okay, in 2019, Uh, we lost 47,351. In 2020, we lost 53,370. 2021, we lost 83,515. So they're losing more and more, and you can then go through and be like, okay, well, why is that loss happening? If you see between 2020 and 2021, their total operating expenses almost doubled, right? Like, I guess not almost doubled, but it went from 56,000 to 84,000, right? And so that was a significant increase. Um, uh, as well as their total cost of revenue. And so you would basically look at this and try to be like, okay, well, what changed? Are we just always running at a loss? And so if we have more business, we just start creating more loss. And that's something to then look at and fix, right? And that means that you then have an issue with like your initial revenue, right? That number needs to go up to help you. Um, you know, or maybe your issue is on your expenses, and you might then have to take a look at what expenses you can cut down on, right? Um, um, and then the last two numbers, uh, they just gave you 2020 and 2021 in 6 months. But like I said, so this would be what 2020 looked like by July 31st, from January 1st to July 31st, and what 2021 looked like from January 1st to July 31st. So that way you can look a little bit more in depth as to like whether something, especially if you change something halfway through the year, you would want to see that kind of split. So that way you can see how your policy changes uh, affected your finances. Um, okay, next page. Okay, this next one, same idea. There's a very large, complicated statement of financial position. It is technically 2 pages. They're just next to each other. So the first side has your assets. The second side has your equity and liability. Um, uh, Equity, you don't really have to worry for unless you're like offering stock, right? This is a company that is publicly traded, so they have equity. Um, uh, okay, so under do I have? Can you just go to the next page real quick? I just want to see. Okay, cool. We do. Okay, so terminology in the statement of financial position. Um, you have under assets, you have a couple of different categories that you're seeing here. Some of these you won't see unless you're in like much larger organizations, but we're just going to go over them. I'm just putting it out there because you won't necessarily need to know all of them, but it's still good to at least have an idea in case you ever come across them, right? So your non-current assets, or it might also be called fixed assets. Um, they can sometimes also be called long-term assets, but that's kind of rare. I didn't include it there, but I'm just throwing that out there. Um, those are assets that are kind of fixed, fixed in something. So if you own a building, if you own property, that's a non-current asset or a fixed asset. Your office furniture are also fixed assets. You can't just there is a dollar value attached, but it is not liquid. You can't just spend that right away, right? And that's the difference. That's what they mean by like liquid. Is liquid is like how quickly uh, can you actually produce this money to someone? Um, and so you want to keep track of those. They're important, especially as you're like going over time, because a lot of your non uh, current assets and fixed assets will depreciate over time. So when you have and if you go on the IRS website, they will tell you um, what the different differentiations uh, depreciation schedules are for different types of assets. So if you have uh, like a laptop, they might tell you it's like 5 years. So now you take the total amount of your laptop, and if it's an expense, you would split up that expense over those years. But if it's depreciating in value, then when you first buy your laptop, I don't know, let's just say it's worth $1,000. Um, and then by year two, and so now you have 5 years to depreciate that. And so um, you have a little bit of fluidity on how you separate it out, um, but it can't take longer than 5 years. By 5 years, uh, that asset is going to become a $0 asset. Um, okay. Um, Intangible assets. Intangible assets are kind of what it sounds, things that you can't hold, things that you can't touch. So if you have a license, or sometimes your list of funders can become an intangible asset. If it's something that you have that you can sell but can't be held, that's an intangible asset. Um, uh, Goodwill. Goodwill is the sure sign in a company that they have bought other companies in the past. Because what goodwill means is it is when you're buying a company. If you're a company, you're buying another company. Like I said, the first steps is that, like, there's evaluations, right? So your CFO will be evaluating your company, their CFO will be evaluating their company, and that's how they decide how much to sell it for. And then you're kind of negotiating. And so if the valuation price is basically based off of your assets, right? Like how much assets you have. Um, your statement of financial position is going to be pretty important in that, because it gives you like what your company's worth for like eh, for most of your assets, right? That you can sort of put a number to. Um, so let's say company A is buying company B. Company B's valuated at $1,000. Just keep the number simple, right? You get in there, you negotiate, but company B happens to be, I don't know, Nike, right? So company B might be valuated at $1,000. They might have $1,000 worth of assets and a net assets, right, after like their liabilities. Um, but they have a brand name, and that brand name makes them worth more than just $1,000, right? So you buy company B, you buy Nike for, I don't know, just to keep the number simple, let's say $2,000, right? Doubled in price. Uh, then um, $1,000 would be split within your fixed assets and intangible assets, right? And financial assets, like all your other assets. But that other $1,000 that went beyond the valuation, that is what counts as goodwill. Goodwill in corporations is not goodwill the way we think of goodwill. Goodwill literally just means it is typically a brand or something in the company that made it worth more, and it couldn't be part of the valuation because there's no way to know what that price is until someone buys it, right? Um, and so like that would be like your brand name. You don't know how much your brand name is worth, or if you're uh, I don't know, Burger King. It's uh, the ability to franchise, right? So you might be paying more than the valuation because you know that you can have it's already set up to have franchises. And so that additional cost is considered goodwill. Um, I'm not sure why. It's definitely very different than the way we think of goodwill, but that's what it means. Your financial assets is exactly what it sounds like. It's like your cash, your dollars, um, that you would have. Uh, Receivables from financial services. So, receivables from financial services is how much you received for like selling a stock, basically like your investments, you know? Um, uh, that would be under receivables for financial services. Um, if you're a very large company or if you're a publicly traded company, or that is part of what you do, then you would have receivables from financial services. If you're much smaller, um, your interest and that kind of stuff, like I said, can literally go under other income. But if you need to split it out, then that's what receivable from financial services means. Um, Same with deferred tax assets. Deferred tax assets is like you either prepay taxes or you have um, different tax deductions that can be used within the next like 5 years. Some tax deductions work that kind of way. Like if you're showing like stock losses, then uh, you would have tax deductions that you can use for the next 5 years, and that becomes an asset under deferred tax assets because that's now uh, a way to bring down that expense, right? Um, okay, trade receivables or account receivables is an asset. It really means that it's because you're working on an accrual basis. So that's money that you're owed, that you should be receiving that you have not received yet, right? And uh, uh, sometimes it also might be called like aging, um, like in an aging report is that's what would come in, right? Typically in your accounts receivable is like before you do one of these, you would look at your aging report and consider and look at what you're just going to call a wash and like what, this has been sitting here for a while now. We can't count this anymore and remove those. And then what's left would then become your accounts receivable as an asset. Um, I already talked about equity. Equity is about if a company's has publicly traded, it's about how much their stock is worth. Um, Deferred tax liabilities is the same thing as deferred tax assets, except that it's money that you owe that you don't have to pay yet, but you are going to have to pay to the IRS in the future. Um, and accounts receivable as a liability is the same idea as accounts receivable as an asset, except that it's money that you're gonna have to pay in the future, but you don't have to pay yet. Um, okay. Can you just go up 1 second?
Sorry, it froze again. Say that again.
Can you go up one?
Yes, sorry about that.
It's all right. Okay. The other thing to point out is that like a financial position can have notes. So if you see all these numbers are referring to a note. So like and that's where like your CFO or finance director would come in because they would then might would have like a report that also goes with this explaining what's going on. Okay, let's go to two more.
Is that what you meant by two more?
Yeah. Oh, you know what? I did forget about provisions. Provisions is stuff that comes in. It's money that you owe, but you don't know when it's necessarily going to come in. It's like uncertain timing, right? But you know that like you are going to owe it at some point in the future. That would be your provisions. Okay. Go on. Okay. So, but balance sheets do not have to be so complicated. This is a much simpler one. This one just has your cash and cash equivalents. So this is just like the cash you have. Cash equivalents is just like cash in the bank. It's not as opposed to like cash in your hand. Um, Contributions receivable is this company is a bit more philanthropic, so they have their contributions that they received. Um, uh, Assets that they've prepaid expenses. So again, if I paid for like uh, 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 I don't know, Microsoft Word for the next 3 years, this would be 1 year of that of that item, right? Um, because now it was a liability in my year that I spent it, but now the following years it becomes an asset because I have that license still, but do not need to spend it. Um, your short-term investments we talked about, property and equipment we talked about. Uh, uh, so their total liabilities that, like I said, these are like their accrued expenses, their accounts payable, so money that they need to pay or have spent as of June 30th, 2019. Um, and then because they're philanthropic, they do have uh, in their uh, in their assets, they're they split them up by donor restrictions and without donor restrictions. Um, uh, but if you notice, the total of your total net assets and your total liabilities just gets added to 475, and that matches that number because they're philanthropic, they're putting their net assets down there as well, to split within the restrictions. Um, okay, can you go to the next one? Okay, cash flow statements. Like I said, cash flow statements really just show your cash. These ones are sort of much simpler just because people are used to looking at like bank statements. So it's just think of it like multiple bank statements put together and organized by like the way you need to have them organized by your class and by your GL codes, right? And so uh, in this one, they happen to be using 2 years. You don't have to have 2 years. You can have 1 year, but again, oftentimes you're using these to sort of compare or see how things are moving over time. But you might have just 1 year so you can see uh, where things are at. And I think all these are pretty self-explanatory. Go to the next one. Yeah, the only thing with cash flow statements is just your revenues, which is how much money came in, your expenses, how much money went out, and your balance, which is how much money is left. Uh, how are we doing? We got 10 minutes. Yeah, the next one. So these are just different ways that cash flow statements can look, but they're all the same thing. Go to the next one. And this is like a personal one, just so you can get a better handle of it. This is like what your personal one would look like, right? Your salary, any dividends that you might make off your investments, rental income, freelance work, and then all your expenses to go out. Go to the next one. Good. Getting through an audit. It's pretty much all there. The biggest thing is just make sure you're keeping backup for everything. If you have an invoice, keep your invoice attached to so that when you go back, remember what transaction. Make sure you're naming your transactions. Um, um, Make sure that you uh, make sure you're keeping track of all your grant contracts. It does spell out here, so if you just see it, it does spell out like all the different steps. But really, it just comes down to like uh, uh, keep any backup you have. Keep your receipts for expenses. Keep your contracts. Uh, keep your invoices. Um, and then they're just going to make samples from there and ask you questions. But if you have all those things, you'll have all the things that they're looking for when they're asking for samples. It's not tricky. It's just about having good systems so that you're not losing stuff when you're doing this like 6 months later, a year later, 2 years later. Okay. Um, reading the 990, do we have, I know we're running short. Do we have enough time to just do the first part of the 990?
Yeah, hold on, I'll bring that up for you.
Because that's really the main part.
One moment. Give me 1 second. Zoom is not cooperating.
Yep.
Okay.
Okay. This is 990. This is what 990 looks like. If you're a nonprofit organization, this is the type of tax form you would have to be filing. Um, if you're a 501c, they're also public. So you can go find 990s because they do have information for the public to look at. Uh, as you see, this one's for the American Humane Association. If you just can you just scroll down to the numbers? Yeah, to the summary. Okay. So if you see the first part really just tells you stuff about your organization. It tells you how many voting members there are, number of individuals employed, number of volunteers that you might have. The second part is your revenue. So we already talked about all those other reports. This is just the final total report for the year. So this is telling you like how much came from contribution and grants, and how much was like for programs, how much was investment, the same way that like the other reports would have. And then it just lists your total revenue. So number 12 is your total revenue. So if you're looking to see how much someone actually made for the year, as you see, the right side has your current year. So AHA made $16.9 million on 2015, and the prior year, 2014, they made 13.49 million, right? And so that's where you would see that on number 12. On their expenses, it's the same idea, it just gets split in different ways. So you have your how much was spent uh, uh, giving out grants, on salary, on professional fundraising, um, and then other expenses, and then you have your net. So remember, your net is how much you made. So your gross revenue is 16.9 million for the year. Your gross expenses is 13.8 million for the year under number 18. And so 19 gives you your net. And so at AHA for 2015 had $3,124,438 left over at the end of 2015. Um, and then there are other information in there, but that tends to be the hardest part for people to read. Otherwise, you'll also have to list uh, 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 like your top donors over 5,000. Um, so you need to be keeping track of those as well. You'll have to put down your top earners. I believe it's your top five uh, people, and which tends to typically is like your director and other officers, your top level management. Um, s- uh, but this is the main part that most people are interested in, and this is what trips most people up when they try to read it. The other thing to keep in mind is uh, I said before, 501(c)s are public. Churches are not public. Churches get a lot of special rules. They get so much special rules that couldn't I couldn't teach on churches because they're such a different beast. Religious organizations. Um, Otherwise, I think we're in a good spot. Uh, do we have any questions?
There was a question earlier about GL codes.
Oh, for fundraising and lobbying, so you definitely need lobbying. You're probably going to want like state and federal separated. You're going to want that corporate, individual, and foundational funding separated into different GL codes. And they can be sub GL codes, so you can have one GL code for fundraising. I would suggest having a GL code for fundraising, a GL code for lobbying, and then sub GL codes to separate out the three different types, uh, uh, you know, of funding and lobbying. Is there Kat? Do you want to throw in for this one? Kat is also our lead development and is a trained professional fundraiser. So
Um, yeah, so I guess to piggyback on what we talked about previously regarding separating your funding sources, you should probably also separate your lobbying into direct lobbying versus grassroots lobbying because those are calculated differently. If you are going to be doing lobbying, I would heavily suggest that you fill out that one page form called the 501(h) election. And that form basically lays out exactly, or it opts you into a much clearer description of how much money you can spend based upon your organization's budget size for grassroots versus direct lobbying, which is why I suggest you have them in separate GL codes. And y- if you look up on, I believe Nonprofit New York has guidelines or has explanations of this, or if you just Google the 501(h) election, there are many, many articles that will talk about the limits that you have for each organization's budget size. I think that at minimum, if you have a budget size that's less than 500,000, then you can spend up to 20% of your I guess tax deductible dollars on lobbying, whether that's direct or grassroots lobbying. And so it's quite permissive in my opinion. You can do a lot with a not-for-profit, and in fact I believe that not-for-profits are kind of obligated morally in my opinion to lobby for the kind of world that they are striving to create and to make sure that that is enshrined in law for the protection of all people. I suggest you become very familiar with what is considered grassroots lobbying, because if you have volunteers who go to your state house to talk to your elected officials, even if you have discussions in your mailing list about issues that affect your community based upon specific specific legislation, just talking about the impact of that legislation, you that is considered lobbying. So you really need to be very clear on what that is, and also to articulate the time of your executive director or your volunteers or whomever to in terms of reaching those outcomes and doing that lobbying.
Cool. Any other questions? Okay. Otherwise, please join us again on April 28th. We're going to be doing volunteer management with limited resources. Um, and um, and keep an eye out. In May, we will be putting out our full fundraising handbook where we're going to include a lot of the things we've been discussing in these presentations, plus a bit more. Thank you so much for coming.